tax implication for those people that they wanted to invest in real estate.
Okay, so again, we are not tax experts and we are not legally you're going to be there. This is a YouTube video. We're going to talk about what we know as real estate agents because we hear it all the time. So we're talking about from the back end of what we see. However, again, we are not the government and there is all of that.
Exactly. Therefore, we wanted to start that. I'm going to ask this question from did you know that IRS audits can happen years later?
Yeah, absolutely. In fact, when I was 18 years old, I did my own taxes. One time I messed up a lot. I got an IRS audit pretty much when I was 20 years old. So I 100% know IRS audits happen. I paid it back. I just messed up my taxes and I've never ever tried to do my own taxes on paper ever again. TurboTax is one thing. It asks you simple questions. I'm talking handwritten, just read and answer the questions because I didn't understand questions. So don't do your own. That's what I learned.
What is the window for the extension
so it's typically 6 years past when you made the claim. They can come back at you. Typically, so that it can be if your unreported goes more than 25%, they can definitely come after you. For an example, just so you know, IRS can happen and they come for you later, so you should always have IRS protection as much as possible. I always pay the extra for the IRS protection audit when I do my taxes.
Exactly. Therefore, let's say making a short example.
No, let's go to the tax shield.
Tax shield?
Yeah.
Okay. Therefore, what is tax shield?
This is the reason many people buy single-family homes, right? Single-family homes and use them as a rental because you're getting the concept of depreciation. What is that? What is depreciation?
Depreciation is that the simple model that every 27 and a half years, we have this model that constantly linearly the house depreciate in that 27 and a half years.
So give me an example.
Therefore, example is, let's say that you have a rental property that you purchased for $275,000 and you can deduct, for example, $10,000 for the property for 27 and a half years, which brings you to what? $275,000, which provides you a tax shield that reduces on your taxable income.
The next thing we want to talk about is modifying accelerated cost recovery system, the MACRS. That's how I say it. I don't know how everybody says it, but either way, certain improvements can be tax deductions, and they can be depreciated over shorter times than the whole building itself. For instance, your HVAC.
Yeah,
right. So
for example, you install a new HVAC, and for the sake of simplicity, we say $5,000, but this is more than that, $5,000. Therefore, under the MACRS that my wife said MACRS, you could potentially write off how much these expenses in a 5 to 7 years period instead of 27 and a half years that we talk about depreciation of your property.
The next thing is taxes on profit. And this is where a lot of people run into trouble with single family homes. If you sell your single family home and you do not reinvest it into another single family home, you're going to have to pay capital gains on this money. So when you're selling your real estate tax thing, it's better to make sure that we're not paying these capital gains, but it can also depend on, these capital gains depends on your age, your tax bracket, how long you owned the property. So there are rules that go along with your capital gains, but if you are selling one home, the house you live in, and you want to buy another home, the best thing to avoid capital gains is just reinvest the money. That way you're not, you're washing your hands of it.
Therefore, a simple example is, for example, you purchase a home, single family home for $250,000 as a rental, and then you're renting it after a couple of years or after a period, you say, oh, it has a good appreciation and I want to invest to something else for my portfolio, and you can sell that house for $350,000. Therefore, you gain really capital gain of $100,000, which is taxable. That could be taxed 15 to 20%, but that's overall taxable, depends on how long also you have held that property in your possession.
The next thing we want to talk about is the 1030. Oh, let's do our introduction. Let's hit it. Hi, it's Alan Victoria. Welcome to our channel and podcast.
And if this is your first time in our podcast and YouTube channel, make sure you subscribe and get notified.
Also, you call text all the time, 252-327-3357. We love talking to you. Don't be shy. Also, grab our buyer's guide and seller's guide in the description below. Now, let's talk about the 1031
Exchange.
1031 exchange. Pretty much this allows you to defer your capital gains by reinvesting the profits into a like-kinded profit. So if you already own a home and you buy another home, you can avoid paying the capital gains because you're reinvesting it into a home.
Exactly.
So if you sell one real estate and then you use it to proceed to buy another, you're deferring it with a 1031 tax exchange.
Exactly. But I wanted to mention that is super important. When you wanted to use 1031 exchange, you need to make sure that you're closing on your house either at the same time you're purchasing the next property or before that one. Otherwise, you cannot use the 1031 exchange for next property to defer from the capital gain.
Use your lawyers. Next one is the passive activity loss rule. Not all losses are created equal, basically. The IRS will categorize rental activity as passive income, which means that your losses cannot offset non-passive income unless, of course, you're a real estate realtor. Now, for instance, if you have a day job where you make $100,000 and you lose $5,000 on your rental, you cannot deduct $5,000 from your wage, from your $100,000 wage. That's not how it works. You can use for in other things, but you're not deducting it from your wages.
Therefore, this is also super important. The next thing we wanted to be, what we wanted to talk about.
Record keeping.
Record keeping. What is about the record keeping?
Make sure that you're keeping a track of everything. You're keeping track of your expenses, your repairs, your income, your losses. Because if the IRS is coming for you and going to audit you, you want to make sure that you hit them with your paperwork. You're coming with every repair to every rental property, and you can have all of these expenses and ensure that your legal deductions are going to continue from there.
Exactly. Therefore, you have these net sheets that you say what is your expenses is, what is your income is, categorize them, and you can download it too, and then put everything in order for the audit in the necessary time.
So we hope you loved our basic rundown of legal implications, because this was, something that you do need to know if you are considering buying a home
as an investor.
As an investment.
And don't forget to call Alan Victoria. We are a real estate agent in Greenville, Winter, North Carolina. We love to help you, and call us at 252-327-3357 or go to our website, alandvictoria.com. We love to connect with you and help you.